Hello, everyone. Welcome to our Title Success webinar on joint ventures. We're very excited for the conversation today. I know that there are some of you that are watching us live. There are some of you that are going to watch the recording later. Either way, we've got lots of information for you. We'll make sure if you're watching this as a recording, we'll make sure in the description that you've got any links that we talk about, contact information for our speakers and all of that sort of stuff. If you have joined us live, please feel free to use the chat functionality anytime throughout the presentation here, and we will make sure that our speakers answer those questions. We can all see it, so we'll kind of be watching as we go, but if anything kind of gets buried, I'll make sure that we bring that up to everybody. For those of you that don't know me, my name is Wayne Stanley, and I'm the owner of Bo Digital and one of the partners in Title Success. Very excited to host today's conversation on joint ventures. I know it's a hot topic, and with everything that we're doing in the mergers and acquisitions space right now, it's something that we definitely wanted to talk through. And then these days, whenever we go to these events, whether it's online or in person, I always think that sometimes when we read the bios, it just gets a little crazy and stale. The presenters sort of stand there like, what's happening? So I'm going to let our wonderful presenters introduce themselves today. First up, we've got Loretta Salzano, and then followed up by Marcus Hunt and Pat Smith. Loretta, you want to go first?
Wayne. Sure. Hi, I'm Loretta Salzano. I have a law firm in Atlanta, Georgia called Franzine and Salzano. We just celebrated our 25th anniversary, of which I'm very proud. And I spend most of my time practicing law, or at least probably half of it, advising clients on compliance with RESPA Section 8. So I am seeing a proliferation in joint ventures and affiliated business arrangements. So I'm happy to be invited to join the conversation.
Great.
And thanks, Wayne. I'm Marcus Hunt with Title Success. Also have a title company, South Oak Title, kind of offices throughout the Southeast, and just excited about being a part of this. Again, as Loretta said, we've seen more and more activity in the joint venture space. We've obviously had more real estate companies approach us about, putting together a joint venture, and so I'm excited about kind of talking through kind of the ins and outs of JVs today, and glad to be a part of today's cast of characters.
I'm Pat Smith. I am the president, I suppose is the title that we have at the moment, and co-founder of Title Success. I'm an attorney. I live down on the Alabama Gulf Coast in Orange Beach, Alabama, and work from there. Spend the majority of my time now working with Title Success and its clients on valuations, succession planning, mergers and acquisitions, and exit strategies for title agency owners. It's a labor that I come to after spending about 15 years running a large title insurance company here in the state of Alabama, one of Marcus's competitors, and we've been friends throughout all of that. Background-wise, I'm an attorney, private practice for a number of years now, 15 years, in-house counsel and title insurance company for a large real estate agent. So I've got a lot of experience in the affiliated business field. I've dealt some, as Loretta says, with RESPA Section 8 as well as 9. And so kind of bring that experience to the table. And I'm happy to be here to see if there's anything that I can help us get through today, talking about the opportunities and pitfalls surrounding joint ventures between various entities in the title insurance and settlement world.
See, this is why we let the speakers introduce themselves. I would have never done as good of a job, Pat, of going through that history there. Well, let's kick this off and talk about a little bit. I know probably Pat and Loretta, this is in your guys' wheelhouse, but what's the current environment for joint ventures? I know that it's different all over the place, but what should people know, and why might now be the time to consider starting one?
I'll jump in and talk about what we've seen. When we're looking at title companies and other real estate entity operating results from the last few years, 2019 was a good year. We go back 3 years, everybody was doing pretty well. Things were on the uptick. We were had some enthusiasm looking forward, and then COVID hit in 2020, and we're like, oh my God, what's going to happen? Well, what happened was in 2020 and 2021, those years were crazy for most people. I mean, income was up, transactions were up, everything was up. And everybody stayed really busy just trying to get through the orders and everything that was coming through the door. Then we get to 2022, and suddenly we have people start saying the sky's falling, the sky's falling, the sky's falling. We're not so sure that the sky's falling and maybe just some clouds rolling through. But what we've started to see is that title insurance companies, real estate entities, mortgage lenders, builders are looking for ways to continue that period of growth that really got started in the 2019, 2020, 2021 era. Because organic transaction numbers have pulled back a little bit to a more normalized levels,
right,
if you will. Then everybody's having to look to some different ideas as how to continue that growth. And one of the ways that many people are looking to try to continue that growth phase is by getting into the affiliated business type world and consolidating or combining the real estate related services through, for example, joint ventures between real estate brokerage companies and title insurance companies, or lenders or builders and title companies. A little bit reminiscent of what we saw back in 04, 05, 06, but for maybe different reasons. So right now, what we're seeing is companies looking for other revenue streams, and they're looking to joint venture the title and settlement industry to do that.
Well, and Wayne, from my position of having a title company that's regionally based, I mean, you get approached by I've had a handful of real estate companies that have approached us, and okay, they're getting squeezed because margins and caps and all this that the real estate brokers are having splits that they're having to deal with when it comes to their real estate agencies, and so they're looking at ways to make up kind of revenue because they've been squeezed so much. And so I feel like in our world that's kind of the question that initially pops up, and why a lot of real estate companies are kind of out there looking for other streams of income, basically.
Absolutely. I think the disruption in the real estate brokerage model, where a lot of brokers are having to give up 100% commission, they still have to make their nuts. So where are they going to find it? And the extent to which they can drive business elsewhere can be a great source of revenue. Kind of the flip side of that is they can't always drive the business, and it's really up to the agents who are going to be making the referrals and who are going to be the leverage for capture rate. So we've also seen in our market a lot of interest in folks, well, not just our market, a lot of markets, in inviting agents to the party so that agents have a piece of the pie. And that raises sometimes securities issues, and it makes it a little more complicated from a corporate governance standpoint. But that's been very popular, and well before the dip in product in 2020. And then I think it's just seeing what your competitors are doing. Many people who contact me, it starts with so-and-so down the street, or my competitor's doing this, or how can they get away with that, or how can I do that too? So I think it's just something that is becoming more common, and so it's more acceptable. And if you're trying to keep your door open and you're competing for business, whether it's because the agent and broker has their hand out saying, what have you done for me lately? Or you're just trying to keep your pipeline full, it's a really great way to earn business if you're willing to give up the portion of the title insurance premium that you might have to give up in order to garner that business.
Loretta, I was going to ask, in your world, because again, I feel like once someone comes to you, they've at least made the decision and taking that next serious step. Are you seeing?
Not really, but okay.
Yeah, well,
sometimes you're weighing options. Should we do an MSA? Should we do a joint venture? What else can we do?
Well,
they don't want to do it, but once they decide they have to do it, then.
Do title companies come to you more, or is it real estate companies kind of out of the gate? What do you see more of?
We're hearing it. We have all different kinds of providers. Right now on my desk, I have a project that was initiated through a real estate brokerage, although I work primarily with the general counsel for their title company. I have another one that is a new mortgage lender that was started by a real estate brokerage that already has a title affiliate. And then the third one is a real estate brokerage out in California that's expanding and trying to give their agents a piece of ancillary services. So they're starting title across the country. I have another one that's driven by the mortgage lender. So it's interesting. And a lot of our clients in Georgia are law firms. So in Georgia, oftentimes it's driven by the law firms who are trying to get a bigger piece of the pie from builder or broker or even agent relationships. And because they're lawyers and we're in an attorney closing state, they're especially sensitive to complying with the laws regarding the practice of law and at the same time satisfying RESPA. So for the Georgia clients, I would say most are precipitated by a law firm, but otherwise the relationships are all different kinds of folks.
Okay. That's kind of mirrors what we've seen, I think. Yeah.
I did get a question texted to me from someone that didn't necessarily want their name in the chat for this, but Loretta, talk a little bit, just very briefly, about the change you were talking about that's happening with brokerages. I think that there are some in the title industry that may think that that's not happening in their area or that it's not quite as widespread as it is, but just in general, like, what do you mean by that? And what should people be preparing for or thinking about with that change? Because it is, if it's not happening in your area, it's coming.
Right. Yeah. So, traditionally in the real estate broker world, and I can't say I'm an expert, but I have been married to a real estate agent for 25 years. And when he was first shopping for a brokerage, he was looking at split and support and what he got. And, oftentimes the split to the, agent is maybe 70 or 80% of commission. Oftentimes they have to pay a desk fee or a rental fee, or maybe they have to sell a certain amount until they cap, at which point they then get 100% commission. And really that share that goes to the brokerage is in anticipation of paying for and covering all of the supportive services the broker has to do, whether it's their rent, it's their technology, it's licensing, it's all of those things that the broker does so that the agents can hang their license there. Now, over the past several years, there have been a lot of models out there where the real estate brokerage gives 100% of the commission to the agent out of the gate. And maybe there are lots of variations on the theme, and I'm not sure about all the different initiatives out there. Sometimes it's 100% commission, but there might be certain fees charged or fee charged for certain supportive services that the brokerage provides, but not always. And part of that's a way to grow the brand in the market and make the brand more attractive to other agents. And maybe those agents don't all get 100%. But you can imagine, as you talked about, gentlemen, if the squeeze is, if maybe the brokerage is used to getting 20% on average, and all of a sudden they're getting 2% on average, they have to make up that 18% or whatever the difference is somewhere, and because they have to keep the lights on. And so affiliated business arrangements are a really great way to make some extra income without squeezing the agents.
And I just thought that was an important piece for people to understand as they're thinking about, because I think a lot of times what we see a lot in the title industry is we're focused more on like the agent activity and not always what's happening at a broker level. And so I think that was a good question, and I wanted to make sure we asked it now. So let's take that a step further, though. And I know, Marcus, you've talked a lot about this. Who are the good candidates for this type of entity? What makes the most sense for people right now?
Well, and obviously, we've kind of hit on, our real estate partners and clients are, in our title businesses, they drive a lot of the business to us. And so they're the most obvious, I think, partners. But I kind of circle back to what Loretta said earlier. You've got to really then decide, is it the broker that you're wanting to partner with and that, maybe allows access to the entire office and kind of get you in front of, kind of the full office of real estate agents? Or is it, one of the things we've started looking at is, we're trying to find the best teams, and maybe so you find a handful of really good teams that you bring into a joint venture. And then you're really, because those teams are the ones that are really producing. I go back to the 80-20 rule. It's 80%, 20% are doing 80% of the business. And so if you can find that 20% of realtors that are really driving the majority of closings, then pulling them into, or at least a handful of those agents, or especially the ones that have teams, into a joint venture is a really good way to create a good partnership. And so, but there is that balancing of, do you alienate a whole office and just pull in teams, or do you do the entire office and work with a broker? So real estate, partners, lenders, right now we're not in any kind of refi, boom, and refis are pretty much, non-existent. And they just trickle in. But at some point, that refi business, there's title companies we know that we're good friends with that literally live and die off of the refi, upticks. And so having relationships in those spaces especially when it's, the refis are going full speed and the rates have dropped is a great place. And then we talk about builders. Pat and I have worked with several clients that have builder relationships and have brought in builders into partnerships.
Yeah, and then some of the large builders in the country, D.R. Horton just comes to mind, have gotten into that business whole way. They have their own affiliated integrated businesses. So we'll talk a little about how builders and others fit into not just the JV opportunities, but also the merger and acquisition opportunities for outright acquisitions. But those are the kind of traditional candidates for joint venture activity. Those are the ones that we see most often, the ones that I've worked with more over the years. And
Wayne, I've even seen and then kind of the combination of it. I've worked with a company in Tennessee where they brought kind of all the players, a lending piece, a realtor, and the title piece, and kind of everybody circled around and created an entity to share services and resources. So so it can be kind of multiple partners, as part of the deal.
And it's not a cookie cutter approach. Every opportunity comes with its own unique features and challenges. But I guess the short answer to the longer discussion is that anybody in any profession that is involved with and related with the real estate industry is going to be a potential candidate for a foray into the title insurance and settlement industry, depending on their market position, what their revenue drivers are, and where they see themselves in that cycle.
Yeah. And Loretta, I want to kind of roll back to what I think is a very important one, and it kind of plays into what I was talking about, whether you're bringing in teams or multiple agents. Talk briefly about like the securities issues that could pop up when you.
Oh gosh, I'm not a securities lawyer, so you shouldn't ask me that. I can tell you that
you opened the door.
I know. Well, because whenever we're working on these, I think I mentioned to you when we were prepping, it's important to have good corporate counsel. We're a RESPA counsel. We advise our clients on the state law limitations and requirements. Oftentimes, there's a controlled business limitation. There are other things to take into account. But it's important to make sure the organization is structured appropriately and that you are appropriately offering interest to folks that you wish to engage. And there are, I think, 3 different levels of how that might impact you, both on whether you have to register the security, what notice you have to provide, or if you have to do nothing at all because of how you're offering it. And that depends on several factors, one of which is the number of people you choose to invite, how you decide to invite them and advertise this opportunity to participate in this business. And then also it might be that you can escape registration by having only accredited investors, which are investors that have certain net worth or assets, I believe. So you shouldn't just go into this willy-nilly with a simple organizational package that you do. Okay, we're going to buy the package to set up this LLC, and then we're going to get our operating agreement, and we're all going to be good to go. Then we can put a broadcast out that, hey, agents, if you want to send us business, you can participate, you can join, because you might be running afoul of securities laws. So make sure that you do it through competent corporate counsel, and that law firm or that attorney also can help you make sure you don't go to jail for some kind of securities violation.
Yeah, let's make sure that we're talking about what repercussions can be here. And this brings back some old things about if you do this, you get a fine. Okay, we don't want a fine. If you do this, you get your name published in the bar journal. We don't want our name published in the bar journal. If you do this, you go to jail, and we really don't want to go to jail.
Yeah.
Always. It's also a federal crime to violate RESPA, right? But I don't think I've ever seen anyone go to RESPA jail.
I hope not. I hope nobody goes to RESPA jail. Loretta mentioned, parties to joint venture and structuring. So this is where, and we're going to talk a little bit later about the necessity or having what we call a team of trusted advisors. But let's just get to the point to where you're in the title and services, settlement services field, and you're approached by, let's say, a real estate brokerage about structuring some sort of joint venture, putting together some sort of mutual operations. Now we're at a point where we have to start looking at what's that going to look like. I mean, is it joint venture going to be an LLC or somebody buying into our existing company as an owner, so that the real estate company is going to be, the broker is going to be a part owner of the company we have now, or are we creating a new entity? How do we go about that? And somebody's asked the question, how many closings per month are the minimum it takes to make this work out? And I really think that when you're crossing that joint venture threshold, that's one of the things that you got to look at is what's the revenue stream going to be, and what are the opportunities? Someone that I used to work for that I have a tremendous amount of respect for is a very big name in our industry, told me one time, says that the thing you got to think of a joint venture as a pie, and the pie has to be big enough for everybody to get enough slices that they're not hungry anymore. Yeah. When you're looking at how many transactions it's going to take, you need to look at what's your revenue model, what's the rate, what's the settlement rate, who's doing the settlements, and then it gets down to how many referrals do you anticipate or you think you're going to be able to successfully bring into that joint venture, and you have to run the numbers. It could be as few as 10 or 15 transactions a month. It could be as many as 50 to 70, just depending on the market and depending on what your particular revenue model is. So, when we're looking at this, we need to figure out who the players are. What's that entity going to look like? Are you going to buy into our existing company? Or are we going to create a joint venture? And if we're going to create a joint venture, how are the services going to be done? Loretta will talk a little bit about the necessity of that joint venture being a bona fide operating entity, not just a paper entity that farms everything out to different people.
Right.
Once you make those decisions, then you can start working with your corporate counsel, working with regulatory counsel to craft those documents, so to make sure that everybody has the right level of input, the right level of influence, the right level of management, and that everything that you're doing is going to be in compliance with the myriad of regulatory framework that we have to deal with in.
Well, and I'll jump back in on the just kind of minimum requirements. I think that's a big piece. I think that's kind of one of the things that kind of out of the gate, before you like really start running and circling up your team, you really do need to figure, okay, is this a viable company, or is there going to be enough revenue, enough income here? And it's different in different industries. It's different per state because our rates are different. And so whether that's, title premiums or settlement fees, there's a broad, spectrum of fees. And so it really does, you kind of got to drill down to, what is it going to cost to run this business? Okay. So then how many deals do I need to do to break even? And then what is that, amount to be worth it?
Let's say that I own a real estate brokerage that does 100 transaction sides a month. And about 50 of those transaction sides come from whichever side of the transaction drives settlement title in the local market. Because it's different. Some it's the list side, some it's the sell side. But say I've got 100 transactions a month. 50% of those, potentially, we have the ability to refer. you're not going to be able to get 100%
Right,
capture
capture
rate
rate,
from a group of independent real estate agents. It's not going to happen.
Right.
You know, in some places, 50% is a really good rate. And so if you can get 50% of that 50, now you've got 25 transactions a month that you can refer. 25 transactions a month, and our market would generate X number of dollars per transaction. That's this much top line revenue.
Yeah.
Now, what's it going to cost us to produce and do those titles and those settlements?
Yeah.
Then you start to get into the numbers, run the pro formas to see if at the end of the day there's enough bottom line for everybody to make sure that
and that's what
is worth it.
You know, and Wayne, we've been able to help clients, you know, kind of do that initial step of running that pro forma, kind of being able to, you know, rough out a number of, okay, this is where we feel like you need to be to at a minimum, and then if you get this many, the profit margins are going to probably be here, and then, you know, kind of build off of that as far as what the numbers look like. But everybody wants to know. I mean, we're doing this to create revenue and to better our companies and to grow. So, I mean, that's really the bottom line when people kind of jump into this space.
And Loretta's going to talk about this, but there is a cost factor to getting into the joint venture.
Right.
If we're going to set up a new entity, and with all that goes with it, bank accounts, escrow accounts, we got to have software to work on. We got to have this. We got to make sure that entity is properly capitalized, and I think Loretta will have some general thoughts.
Right, absolutely. I mean, that's the first thing. And when Marcus talks about the pro forma, I think it's really appropriate that that's a good first step. If someone approaches you or you want to do business with someone as a joint venture or however you're going to structure your affiliated business arrangement, you need to get those numbers on paper. And a good rule of thumb, although it's not mandated by RESPA, is that you capitalize the venture at all the startup costs, all those things that you just mentioned, Pat, plus 6 months of operating expenses, assuming no income. And once you get that pro forma on paper, you might see that there's a disagreement among the parties about, well, what do we really need to run this? Like, you know, when we look at, again, best practices from the 10-factor test that does not have the force of law in every jurisdiction, but certainly is something that the regulators are going to apply, and you should think about, that you really want to make sure that this entity operates like a standalone would. Does it do essential core title services with its own dedicated employees? Is it managed by its own employees? Does it have its own, you know, equipment? Has to pay fair market value for its space? There are all these things to think about. So when you put pen to paper and come up with this number, it might be that the partner you think is going to be a great partner either says, we don't want to spend that much money, or, hey, can't your employees just do that? You know, you have the expertise. Won't you do those things for free? And that can't happen, because if the non-referring owner is giving free or discounted services, that's an impermissible thing of value to the referring service provider. And oftentimes I see a natural tension, especially when, sorry guys, you know, we lawyers are involved. And I see that a lot in our state, where law firms close loans and then they want to form a joint venture title agency with a real estate broker perhaps. And the real estate broker has a much different appetite for risk than the lawyers do. And they're like, oh, well, we don't really need an employer. Can't, you know, maybe we can just have a part-time person come in, and can't your employees do all of those things? And do we really need a lease? And why do we need our own technology? And can't you use your licenses? And we don't want to print business cards, or can't we scrimp on this and save that? And so that invites risk. And these are all business terms that it's important to hash out and sit down and talk about before you start, you know, the train leaves the station, because it might be that they're not willing to ante up, or there's going to be this tension that prohibits you from complying with the law as you continue to operate.
Yeah, I think some of the best joint venture arrangements I've seen is one where the parties come to the table, they go through, they make all their homework, put the money in if they need to capitalize it, do it right, hire a competent, qualified manager, and then get the heck out of the way and let them manage. You know,
that's exactly right.
You know, take the benefit of the profits from the ownership, but let the professional manager title people do their thing. Some of the ones that have been less successful are ones where real estate broker or somebody's tried to exercise, a lot of influence and control over the management of the title company, which is, a different world. I think those of us in the title space know that it's unique unto itself. Yeah. So none of that's being said to discourage anything, but I think Loretta, as well as anybody, would agree that joint ventures are a wonderful vehicle for doing just what you want, for enhancing revenue and enhancing your customer and agent experience. Yeah. But you just got to be willing to make the commitment and do it the right way up front.
That's right. And there are some areas where maybe you're comfortable, everyone would be comfortable with risk. There are only 3 requirements for the safe harbor: that you give the disclosure that you don't require the use generally, and that the parties only receive a return on their ownership interest or some other RESPA compliant compensation. So it might be that as long as you lock down those 3 factors and they're airtight, you might be willing to take a little bit of risk in some of the other areas, especially during startup. Maybe you'll be comfortable with some shared employees or joint employees or leased employees, as long as everyone's paying fair market value. It's fine for what I always think of as kind of the expert partner, the title experts, to provide administrative services. Maybe they'll provide accounting, they'll do licensing, they'll do compliance, they'll help with reconciliations. Maybe even the other partner will have some special expertise in HR, or they might be able to harness the benefits they offer their employees to offer them to the employees of the joint venture title agency because of the degree of common ownership. So there are lots of things that each of the parties that are owners can bring to the table. And there are lots of areas where RESPA doesn't absolutely prohibit certain models, but you just want to make sure that you're on the same page with your risk profile, or it can create tension.
Yes. I agree with everything that Loretta just said, and I've seen that happen. Yeah. In different scenarios.
What about when it comes to the regulatory and compliance side? We've started to touch on this a little bit, but Loretta, what else should they be thinking about in that piece of it? You've got to make sure that you've done everything on the setup, but then sort of ongoing compliance and on the regulatory piece. How do they be thinking about?
Yeah, sometimes the wheels fall off when it
right.
starts going, right?
Yeah.
So yes, I've drafted beautiful packages of affiliated business arrangement disclosures with processes and wonderful instructions about when they all have to go, and it doesn't happen. So once you're up and running, you have to make sure, of course, that everyone understands their obligations to provide disclosures at the time of referral. It's not enough that it happens at the closing table. It just miraculously appears then. So you have to make sure that you're providing correct and timely disclosures of the relationship. And that's sometimes required by state laws as well. There might be state laws that impact various parties. For instance, there are state laws that impact mortgage lenders related to conflicts of interest that those participating parties might need to give, as well as just the disclosures required by RESPA. You want to make sure that everyone else, if there are changes in ownership, that you're updating those disclosures. You want to make sure that there's not undue arm twisting or evidence that any party is required to use the affiliate. And as Pat and I both know, regulators sometimes take a very aggressive interpretive approach to what constitutes required use. While we'd love, and I'm sure the real estate brokers would always love to pre-populate your contracts to say that the parties will use the affiliated title venture, that's a dangerous idea, even if it's revised or edited out 80% of the time, because that might be construed as required use. You certainly can give financial incentives to use affiliated parties, keeping in mind any limitations due to state anti-inducement laws that might limit the title agency from providing financial incentives. But it's not uncommon, as we know, especially for affiliated business arrangements with builders, where the builder might offer some kind of a perk to the home buyer if they use the affiliates. So you want to be careful to make sure that also that the way that these benefits are touted is correct and complete and doesn't create some kind of an unfair and deceptive trade practice. So it's important that somebody's keeping an eye on how the venture is being operated. And whenever we work with clients and provide the disclosures, we always suggest that they just calendar an annual refresh just to make sure. Are the processes still the same for the timing? Are these disclosures still correct and complete? Have we changed ownership? Have we changed our services? Have we changed our fees? What might we have to tweak, just as a little health checkup on the RESPA compliance? And it might be too that under state laws, for instance, Marcus mentioned Tennessee. Tennessee has a controlled business limitation. It has a workaround if it's attorney operated, but when you renew your license, you are making a certification that you're operating in compliance with those state law requirements. So if you're operating in a state that addresses or governs affiliated business arrangements in the title agency space, you want to make sure that your checkup also includes any state law considerations.
And Loretta, just to confirm what you were saying, in all the times that I've been asked to advise on or work with someone who is considering setting up a joint venture or affiliated business arrangement, I've said just the exact same thing you did. We can set all this up on the front end. It can look absolutely beautiful. The documents are gorgeous, but we know that once you get out there and get in the space and start doing, that sometimes things just happen. Things aren't attended to. Things get fallen by the wayside. And I've done exactly what you suggest, is that do an annual checkup, a review, an audit, check in, however you want to do it. And have somebody come in from outside who understands, whether it's an attorney, whether it's a consultant, whether it's your CPA who's familiar with this, and go through that checklist, whether it's the 10 factors or whether it's just limited, what you're working on, and make sure that you're continuing to do that. I could probably go to most of the affiliated businesses that I know here in town right now. Within 5 or 10 minutes, we could find something that probably has slipped unintentionally. So that's probably, for any of us, one of the best pieces of advice that you'll hear today is that once you get started down that road, make sure that you're staying on the path.
Yeah.
Be careful too that the third requirement of the affiliated business arrangement safe harbor, in essence, is that you can't adjust ownership interests or distributions based on referral.
That's it.
So that means if someone isn't bringing it like you expected, you can't kick them out either. You have to come up with some other reason, and that should be addressed in your governing documents in a way that's RESPA compliant. But it wouldn't be very hard for someone to follow the money or follow the referrals or look to see what happens. Sometimes I've seen, I receive operating agreements that are written that says everyone agrees they're going to refer, and every year we're going to reassess, the ownership interest based on that. Or there might be something discretionary in there that might indicate that either ownership interest, buy, sell, exit strategy, or even distributions is at the discretion of a manager or discretion of a board. That invites inquiry. So you want to be very careful that it's locked up. And it's important too, I think, in your governing documents to have some kind of a RESPA savings clause or some kind of a clause that says, no matter what, none of these things ever happen based on referrals. And I think that's especially important to me as a non-tax attorney when I look at a complicated operating agreement with all of these provisions addressing allocations or adjustments or distributions based on certain tax considerations, which is fine. But I just wanted to be crystal clear to anyone who picks that up that those things all might happen, but it's never going to be tied to referrals. There might be other business reasons, but it's never tied to referrals.
Exactly. Yeah, as you were talking about that, I was thinking about all of the limited liability company agreements that we've all seen, and it's got this paragraph about this long there that talks about special allocations, and allocations of profits and losses that are different from the ownership interest. And boy, the room to get in trouble from a RESPA perspective that lies within those sections is legendary. So we'll add tax attorney to our team of trusted advisors at the end.
Yeah.
Well, I know we could talk about the legal side of things.
Loretta and I could talk
Go ahead,
legal
Marcus,
side of
sorry.
things for days.
Well, I was just going to, and I'll let you kind of lead into the next section. I think that we may have been both headed that direction.
I know that I was going to ask one thing before we leave. We're going to kind of shift this into joint ventures in this mergers and acquisitions space. But before we do that, the piece that I'm thinking about, and I know we've got a lot of underwriters that have signed up for this that plan to watch the recording later and share with their agents. Another piece of this is, if this isn't something that's common in your market, if this is something that you're thinking about, and it may be that it's common and you just don't know it, but even if it's not common, how do you start these types of conversations? We've talked a little bit about the candidates and the structure and the legal part, but how do you make those sort of determinations if you're like, this could be a good business model for me and someone down the street, but I don't know how to speak that language or start that conversation?
Well, I think from what I've seen, and again, us that own title companies that have been in the title business, there is this balancing act, and I don't want to give away all the secret sauce of. There's certain markets where joint ventures are an everyday occurrence. There are other markets that I feel like non-existent. And a lot of us title company owners, and any of those that are on our webinar with us, are sitting back like, I don't want to let that cat out of the bag in my market, and start down that road. And so there is this kind of like, at what point? But you also want to be ahead of the market too. And so I think we're all seeing that we're getting asked a lot more questions from real estate partners or lenders, and how can we be a part of this, or can we start our own thing together? And so I think if we're a title company and in a market and it's not really happening, I think you see who the players are. I think you see either the companies or the real estate teams that are successful and that are growing. And I think those are the places you start, because at the end of the day, we said it's one of the most important things before you even get out of the gate doing it, this pro forma. You got to have partners with you that can deliver the business to make this worthwhile. And so I think that's where you start if you're wanting to go down that road with a partner in your market.
Well, and I'll think back, in my private practice as well as in our consulting world today, I've gotten phone calls from state offices of underwriters saying, hey, I got a phone call from an attorney that's representing a lender in wherever Alabama or wherever Mississippi or wherever it is. And, that lender would like to talk about starting a title company. Can you go talk to them? So as for so many other things, the title insurance underwriters can be a great source of information and a great source of direction for anybody that's considering getting into this space. That being said, if you're already in the title insurance business, which I suspect most of our listeners and watchers are, and you have an interest in expanding your operations into that joint venture type space, talk to your underwriter about it. Talk to your state manager. That individual will have a lot of knowledge about how the underwriter looks at that sort of business, how requirements they may have in order to give a separate license or a separate underwriting agreement for another entity. So my advice on any of this stuff is always circle your underwriter into whatever you're thinking about doing.
Yeah, that's a great point.
Because ultimately they're going to go down that road with you. Yeah, and you want them walking with you instead of holding you back.
Yeah.
M&A market and joint ventures. Marcus mentioned one thing. So if you drive down any major highway in some states, in Florida comes to mind, you see buildings that has XYZ Realtors, ABC Lawyers, and MNO Title Company right in the middle, right?
Right.
So pretty good bet that you just stumbled across a joint venture. And it's in almost every block in some parts of the area. Here in the Birmingham market, it's not a common occurrence. I think in the Birmingham market, it's a more common occurrence that a real estate brokerage would own a title insurance company. It would be a subsidiary. So, where do joint ventures fit in the M&A market? As one of the tools, one of the mechanisms by which interested parties get together and expand into the title insurance world. But Marcus and I are heavily invested in the M&A field, and we work with a lot of title insurance agencies who are owners who are looking to take the next step, go the next chapter of their lives. They would like to get out of the title insurance business. They're actively seeking someone who might come in and purchase the operations. And for those owners, the joint venture partners, realtors, lenders, builders, are great sources of potential acquirers.
Right.
So in addition to doing a joint venture, we're seeing more and more outright sales.
Well, and I guess, Wayne, one of the things that I wanted to contribute or kind of add to this when it comes to, at Title Success, we do, kind of heavily, we're known for doing mergers and acquisition work. As part of a lot of the mergers and acquisitions that we're helping with, there's a JV that may be, kind of a side office or a inside entity that this selling, title company has a joint venture with a real estate company down the road. And so I think it's important whenever we're doing mergers and acquisitions, and there might be, say you're acquiring, 5 different locations as part of your acquisition, and 2 of those are a joint venture. I think as part of your due diligence, you've really got to kind of look behind the curtain, kind of what we were talking about a minute ago, kind of like an annual checkup. You need to do a checkup of that joint venture.
Part of the due diligence.
Yeah. And Loretta, what have you seen, I guess, in that space when it comes to someone maybe doing an acquisition, kind of what to look for whenever there's a joint venture involved? What are some things we just need to, pitfalls that we need to make sure we're aware of when we...
Sure. Well, the first thing is I would want to start with the foundational documents, the governing documents, to make sure that there aren't any red flags there, because that will be a good indicator. And then the second big paper thing, trail I'd want to look at would be the disclosures, to ensure that at least the content of those disclosures is correct and complete. I am astounded by how bad ABA disclosures are. There is a model format. It is not rocket science, but rarely, if ever, have I seen a disclosure that I think was correct and complete. You want to make sure that the disclosures are completed, disclosing the fees as they be disclosed on a closing disclosure. You can't include simultaneous issue rates, as I would advise that you make sure that you're following the TRID rules when you're naming and estimating those fees, which is a little different. So you would definitely want to do that. To the extent that you can do a financial audit and follow the money, I think that's something that most folks would do. That's a little bit outside of my area of expertise, to follow the money, but you want to make sure that you're looking at distributions from the venture and that they're only based on percentages of ownership. And if there's any other compensation that is being paid to any of the parties, you want to understand why that is. And if there's a contract to support it, and evaluation of that amount. So when I think about these administrative support agreements or administrative services agreements, which often go hand in hand with an affiliated business arrangement and is fine, you want to make sure that that compensation is the appropriate amount, not discounted, not inflated, depending on the direction of referrals. Also, I don't like to see those called management agreements, because remember, the venture is supposed to be managing its own affairs on a day-to-day basis with its own employees. So one of the owners shouldn't be doing that. Maybe an employee of the owner might be a shared employee in some capacity, but you want to be careful about things that are a risk indicator. You want to look to see, I would look at any advertisements, if there are any advertisements or contracts like we talked about, with whether it's a builder or a real estate broker that has model contracts that indicate there's a required use. If there are financial incentives offered, you want to make sure that those are disclosed clearly and concisely, so that you don't have the risk of a UDAP.
Yeah.
Yep.
Well, before we end, I'm going to ask each of our speakers to give us kind of your one big takeaway. So if somebody, if their brain's kind of spinning after the last 50 minutes together, what's the one thing that they should take away from this to be thinking about, whether it's, underwriters for their agents for their own business, whatever their role is in this. And while they're thinking about their answer for that question, don't forget to use the chat. If you have questions about the chat or about any of this, please feel free to message us. And if you're watching the recording of this, we'll put up the contact information for Loretta and our Title Success folks at the end of this. But Pat, let's start with you. What's the big takeaway that people should have from this?
That whether you are working in an M&A, merger acquisition, sale or purchase world, or you're working through a joint venture, it's vital that as you move into this process that you have a team of trusted advisors to work with you. Loretta mentioned corporate counsel, somebody who's comfortable making sure that we don't run afoul of securities laws, but who also is comfortable working with the right corporate structure of the entity. Regulatory counsel, somebody like Loretta, who is very familiar with and lives in RESPA 8 and 9, as well as state law on a regular basis, to make sure that you don't have problems coming out of the gate. Good CPA or financial advisor who can help put together those pro forma reports, those upfront spreadsheets to see if this is going to be a viable business entity. Insurance for E&O, for general liability, for all the insurance requirements that you need for any business. And finally, your underwriters. Make sure that as you go through this process, that the underwriters that you work with are involved, know what you're doing. They're going to give you some advice. Listen to it, take it to heart. Put together, as the very first thing, a team of trusted professionals and trusted advisors to help you walk down this path to get where you want to go.
Very smart. Loretta, do you want to go next?
I guess I would say choose carefully. When you're considering your joint venture partner, who you're getting into bed with, just choose carefully. I remember when Terry Francine and I started the law firm, in 1996, when we were talking about it, and she said to me, this is like we're getting married, but without the sex. So there you have it. And, you want to make sure that you have the same values, you have the same goals, you have the same risk appetite. It's great that you both are going to have different strengths and weaknesses, and that makes for a strong business, that you complement each other. But there are certain principles that you just want to make sure you're on the same page. I've seen a lot of ventures that don't even get off of the ground because the referral partner doesn't realize, we really have to ante up, or they get off of the ground and then there's a lot of fighting, or depending on who the owners are, there's a lot of, I brought this to the table and you didn't, do your share, and then the deal can blow up. So I think it's very important to do your due diligence and choose carefully, and don't just, oftentimes people come to me and they're virtual strangers. That's a bad idea. If you're not sure you're going to get the capture, you're not sure you're going to get along together, put your toe in the water with a marketing service agreement, or find some other ways that you can get familiar with each other so that you have a better understanding of how you're going to do business together, as well as that it's going to be worth the nut that Pat reminded us you're going to have to invest to make this happen. So I think that's the most important thing, and just to take a deep breath and see how it feels. You trust your gut when you're choosing a partner.
Well, Loretta kind of stole my thunder, but because I do agree, it's very important.
Okay, you talk about all the legal stuff. Do all the legal stuff.
Right. Yeah. But I do think it's very important on who we partner with, and, whether it's cultures aligning or just same vision even, and how you want to, run an operation in an office. Because at the end of the day, it does have to, if you're going to do it the right way, it has to stand alone and run independently of each of your other companies. And so being able to create a new entity and a new business that stands alone and runs really well, I think it starts at the top of who the partners are. So I agree with Loretta in that. And then I think my other just piece is, and we talked about this in the middle of the session today, is just making sure the numbers all add up before you really go down this road. You don't want to look up in a year, 9 months, and you're like, we're losing money and we're all going to have to throw more money into this venture, and then nobody's happy. And then we start pointing fingers about like, well, you said you were going to refer this much, and well, you were going to do, and so all those things. So I think just making sure the numbers like line up out, before we even go down the road very far is extremely important, because it saves a lot of headache, once you're kind of fully functioning and operating.
I agree with all of that. I think those are great takeaways for them. But even with one big takeaway, Mike Combs kind of brought it to a head for us and said, can we get a replay? Because this is still a lot to remember. And we agree. So yes, we will be sending around a recording of the webinar. We'll send around, Loretta gave us some additional slides of some high-level things for you to be thinking about. So we'll include those in the email as well. I get to see these two all the time, Pat and Marcus, but Loretta, it was wonderful for you to join us on this webinar.
Thanks for including me.
We know you have a very busy schedule, and we appreciate it so much. Please feel free to contact Loretta or Marcus and Pat at Title Success at any point to talk about any of this. Like they said, we are, the heavy into the M&A space with Title Success, but this is something else where we want to be, part of your team and part of your counsel, as Pat was saying before, some of your trusted advisors, and we've got that experience. So whether it's through our team, through Title Success, or through other experts that we are lucky to work with, like Loretta, we're here to help. So thank you all for joining us today. We're right at an hour of time here together. We will send around the recording probably early next week. And if you have questions in the meantime, please let us know. Thanks, Marcus, Pat, and Loretta.
Thanks,
Good
guys.
luck.
Thank you.
Take care. Thanks.
Bye, friends.